Hello everyone to this detailed video on the Flexicap research offering from Congruence Advisors. So I guess anybody who's watching this video would have probably gone through our newsletters. You would have glanced through some of the microcap research notes that we've been writing on the website. You would have also, I'm guessing, spent some amount of time on the website going through about what exactly is our investing philosophy in general. So in this video, what we will do is we'll try and give you a very quick snapshot into what the FlexiCap research offering is all about at this point of time, given what has been happening in the market. So starting with the overall portfolio construct. So this is as the name suggests, it's a FlexiCap research offering, which means we'll try and have exposure to all stocks across multiple market capitalizations. So at this point of time, we have about 25% to large cap, 25% to mid cap, maybe about 45% to small cap with about a 5% cash component. Now, if we had to, let's say, talk about the last 7 years of history, I think the large plus mid plus cash exposure has generally tracked an average level of about 55 to 56%, maybe 60% on the higher side, maybe 50% on the lower side. So 55 to 56% being a median number. So that's what the market cap allocation at this point of time looks like. Coming to the sector allocation, you can see it on the screen for yourself. So we like to believe that we are reasonably balanced across multiple sectors. Now, obviously, you will see that this compared to, let's say, either the BSE 500 or the Nifty 50 is a slightly different weightage to some of these sectors. A lot of sectors, I mean, we are probably a little bit overweight on, which are not very well represented in the indices at this point of time. At the same time, we're not really, constrained by the composition of the index at any point of time. So you would see that we hold zero to IT services at this point of time. We have literally no exposure to the to say the consumption sector as such. At the same time, some of the hot themes that are kind of running very well right now over the past say 6 to 8 months, we don't really have a very high exposure over there, though some of the stocks obviously would have some sort of an exposure to some of the silly themes. So this is what the portfolio construct looks like as of today. Now coming to how the underlying businesses, not the stocks but the underlying businesses have been performing, especially over Q4 FY26. Now, the portfolio average YOY earnings growth for Q4 FY26 came in at 27%, which I believe is one of the higher numbers that we have seen for a FlexiCap construct over the past couple of years. So we are starting to get very, very excited about some of the segments of the broader market where we think earnings compounding in excess of 25% can come in. So we will try and, have a healthy exposure to some of those sections. So with just a couple of exceptions. So there's no non-financial stock that is there in the offering at this point of time, where the TTMP is more than 40x, which implies that the portfolio is not really taking very high valuation risk at any point of time. X of financials, the highest debt to equity ratio for any stock in the portfolio is lower than 0.6x, which means that the portfolio company on an average aren't really, high on leverage. We don't like high debt companies as a principle. We believe that debt is welcome, provided it is well managed and it is raised at the right point of time. Now, keeping aside the financial stocks in the portfolio. So when we say financials, we are referring to the lenders and maybe one exception, which is like a small cap at this point of time. See, all other stocks in the portfolio have generated positive operating cash flows in FY26. This is yet another parameter that we really like to see in every single constituent business. So to sum up in terms of the portfolio construct, balance sheet risk at this point is pretty low. It will always continue to be very, very low. Valuation risk, we would say it is moderate because we're not really, into deep end value investing where we target a very, very low PE because it comes with its own set of risks. Earnings growth for the average portfolio right now is pretty high. It's north of 25%. Now, even if earnings were to, let's say, moderate because of the base YOY effect, we believe that the current portfolio will still track an earnings growth of at least 20% YOY for the rest of FY27. Operating cash flows have been very, very good. Now, some of these underlying businesses have displayed very strong momentum since April 2026 because the market has completely, changed its texture over the past 3 months. So while the momentum has been pretty strong in the portfolio, now momentum by itself has never really been a very large factor in our investing style. So what generally happens is we like a story for its own reasons. It fits into our framework. We do a bottom-up analysis. And then the market eventually comes around to our view. And then this story would probably get priced in very, very aggressively in a couple of quarters. So momentum is usually the outcome of doing things well. It is rarely the starting point by itself in our scheme of things. In fact, if anything, we have always tended to prune exposure to certain stocks after we see a very, very steep run up. And this is driven primarily from a risk management point of view. So, just to put a couple of hard numbers over there, so our long term strike rate on stock picking. So, I would say it's been closer to about 65% over the past 6 years, 7 years. So, what do we define as a good strike rate? We're saying any stock where the stock return has exceeded the FD return is a success in our opinion. Now, obviously, the portfolio return would be excessively skewed based on the best case scenario and the worst case scenario. So there'll be some stocks that will do really, really well. There will be some stocks which will probably not perform at all. So the best outcome we have seen is a 19x in the past 7 years. And interestingly, this stock is still part of the offering. It has something like a 6%, 7% weightage. After we have pruned the stock like multiple times, we'll actually lost count of the number of times we pruned exposure to the stock. The worst outcome that we have seen is a negative absolute return of 30% over 2 years. So we obviously will get things wrong once in a while, but we hope to do enough things right so that the success stories more than take care of the eventual mistakes that we will end up doing. So next, moving to a quick performance snapshot. So we're just calling out the performance separately for both the models that we offer. So first one is the website model where somebody comes and signs up for the research offering. You become part of our distribution list. You will get access to the model portfolio. You will get access to the allocation plan. You get access to the quarterly earnings summary and the detailed research notes that we end up writing on every single business. So over there, the onus is that the client would be doing the execution by himself. So the return that we're putting up on the screen is obviously for the model portfolio, assuming that the expense ratio is close to 1%. And mind you, this is the return pre-tax. So we've divided this into two logical periods. So one is starting from the inception date of July 2019 up till March 31st, 2024. And then the second period starts from April 1st, 2024 till as of yesterday. Now, the interesting part is this. I think alpha generation we have successfully done across market cycles and across market pivots. Now, this entire period of close to 7 years obviously has not been simple. You had this big COVID crash in 2020. Then you had this interesting market pivot in 2021 and 2022. The last 18 months have been very, very challenging. In fact, October 2024 to June 2025 was a very, very average period for this particular portfolio. I think our underperformance with respect to the benchmark, starting from the peak of October 2024, was maybe close to 8% at the worst point. But the interesting part is if somebody had not stayed invested in the exact same set of stocks that we've been suggesting, they would have probably missed a good chunk of the recent rally, which meant it would have cost you more than 25% absolute return in a very, very short period of time. So, which is why we believe that performance measurement has to be done across cycles. Ideally, you measure it either peak to peak or from the midpoint to the midpoint, or you measure it, let's say, from the bottom to the bottom. So the idea is to, deliver a healthy return compared to the BSE 500 TRA, which is the most, I would say, suitable benchmark for a portfolio construct of this nature. The idea is to beat it by about 4%, 5% per annum without inducing needless excessive volatility into the portfolio. So while it is very easy to look at the April 1st to June 25th period and say we're beating the BSE TRI by more than 7%, the fact is if you'd measured this, let's say as of March 31st, 2026, the numbers would have looked drastically different. So please have a slightly, I would say, medium term orientation towards whatever you choose, because it takes some amount of time for the market pivot to mature, then for the specific, I would say, fund manager or the research analyst style to sort of mature. So moving on to the second component that we want to highlight. So the Flexicap small case offering we had launched in April 2025. So it's hardly been like 13, 14 months. The overlap of the small case portfolio with respect to the DIY offering is almost 85% as of today. because over there we have taken certain tactical calls which are not very conducive to the entire research analyst advisory model. The reason we have put up the SIP performance is that if you look at, let's say, the 1 month, 6 months, and the 1 year basis, the outperformance actually looks very very impressive at this point of time. But we don't want to make any misrepresentation. Most people who come into the small case generally tend to add capital over a period of time. So which is why we're just putting up the SIP return on the screen. So if you would like to, let's say, get more access to more analytics on the small case platform, you can go to our small case page, check the numbers for yourself. So a couple of points that we really want to highlight: the performance, whatever has come into the portfolio over the past 1 year, it's not limited to momentum because of just one or two sectors. So it has come through multiple stocks that have done really really well over the past, say, 1 year. Interestingly, some of these stocks were the ones that were most volatile through the FY26 period. So when we look back at that, I think it was the right decision. It called for some amount of, I would say, spine to actually stay put in a stock that has fallen more than 50% within a very, very short period of time. So thankfully, we are reaping the rewards by staying consistent with our process. So it was, I would say, it was very tempting to reduce small cap exposure in March 2026, because the previous 15, 60 months essentially told you that you had to be in large caps. Small caps and micro caps weren't performing at all. But we stuck to the process, and today I guess we are looking far better than what we were appearing at the end of March 31st. So just a simple disclaimer that I really want to do is, so I mean, this offering has a moderate level of volatility. I mean, 7 year, if I were to measure, let's say, the 3 year or the 5 year rolling beta, we are probably less than a beta of one. But the volatility can get very, very high in certain cycles, both on the positive and on the negative side. So we would say that this is suitable only for those investors with a time horizon of at least 2 years. Past performance should not be extrapolated, because the nature of the market keeps changing all the time. And as investors, it is our job to basically keep calibrating to ensure that even if you have a bad period, you more than make up for that in the subsequent good period. So negative returns for, let's say, a couple of quarters, 3 quarters, is very much possible. It has happened in the past. So please be mentally prepared for that whenever you sign up for any similar offering, not just this particular offering. So the final slide that we really want to cover very quickly is this. Now, who exactly is this offering really suitable for? I mean, these are some of the points that we really sort of observed real time. We understand our client base really, really well. So anybody who's looking for a differentiated portfolio construct, so essentially a Flexicap construct, to complement existing investments that they may have in the Nifty 50 or the Sensex or any other index fund investing that they're doing. Now, second point is, you will be able to get all of this at a low expense ratio, assuming you can actually grow through a threshold of, let's say, a 10 lakh corpus by the end of first year. Because for the advisory fee that we are charging, you need to bring in at least 10 lakhs of corpus to the table so that you are on par with the mutual fund expense ratio. So what we try and do is, we try to get into stories that can keep growing for at least 3 years, 5 years, assuming the thesis plays out, without paying a very, very heavy price for that. So, I mean, if somebody wants to really work with a research analyst who can consistently and, I would say, reliably calibrate to the changing market texture. Now, this we believe is a very, very underrated skill in the Indian market. It's only in the past 2 to 3 years that you are, starting to see people who are really focusing on this particular aspect. So we see the long term as a series of medium terms. And for you to do well in the medium term, you cannot be very, very static in your entire, I would say, investment approach. Though your investment philosophy can continue to be, exactly what it is. So we don't have over reliance on any single factor. You will never see us getting very, very, I would say, overweight on one single factor, like either growth, value, quality, momentum, and whatever other factor you can really think about. We will continue to be diversified across market caps and sector allocation all the time. So this is one rule we have not really flouted for almost 7 years now. So if you're somebody who doesn't really get worked up over every 10% market fall, because you need to trust your research analyst saying this guy is obviously on the job. This research team is going to ensure that we will never really be, in a very, very bad position over a 3 year time frame. So if that is something that you really value, you should obviously consider research analysts like us who are not excessively momentum focused. And what are the ideal characteristics of clients that we have experienced over the past 2 years, 3 years? So anybody who comes in with an investment horizon of at least 2 years, I mean, ideally it should be 3 years, and it should be somebody who's willing to actually stay invested across a whole market cycle. Market cycles in India generally is between 3 to 4 years. So you have a good year, you have a bad year, you have an average year. So we believe that currently the market is on the cusp of, making a very, very decisive sort of a move. Small caps have done really, really well over the past 3 months, whereas the Nifty hasn't really moved at all. We believe that the decisive movement at the Nifty level could probably come over the next 6 months. So interestingly, our most loyal, I would say, clients are those who have always preferred progress over activity. I mean, we're not really as active as some of the other research analysts in the market. You will not see us giving, let's say, 10 exit calls and 10 and let's say 20 buy calls in every single financial year. So we generally tend to give time to the underlying businesses to perform. So if you're a client who appreciates not just the return, but also, superior judgment that is obviously proven by data, and a consistent focus on risk management at any point of time. So ideally, these are the clients who would generally tend to gravitate towards us. So the final point we would want to probably highlight as part of this video is this. Now, in terms of the models that we offer to our customers. So if you're somebody who likes investing, if you're somebody who wants to, actively stay involved in the entire decision making, what to buy, what should be the allocation, then obviously such clients would want to choose the do-it-yourself model. So in this case, what you would want to do is you just want to go to our website, go to the product offering page. So over there, you will be able to fill in your details. There's a Google form over there that pops up. Once you fill in our details over there, our onboarding team is going to reach out to you and you'll become part of this entire offering. Whereas if you're a busy professional, if you're an entrepreneur who, is looking mostly for an investing outcome, you like to read about, research reports only once in a while, but your professional life is such that you cannot deal with an excessive execution load. Ideally, you should come onto the small case model. Now, small case model, obviously, there is an approval that you will have to give on the app for the transactions to go through, but you don't have to rack your brains in terms of what to buy, what not to buy, and all of that. So, for such people, I would say the small case model is definitely far better compared to the do it yourself model. So please evaluate your own behavior. Please evaluate whether you are a good fit for an offering like this one. And then please make an informed decision. So in case you do choose to, let's say, sign up with Congruence, we'll be very happy to have you on board. And we will continue to interact very regularly from here. Okay. Thank you, folks.